Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Surbhi Upadhyay. And after scaling that 23,000 mark on the Nifty, we've dipped a bit, just down about 30 points from the top. And for the Sensex, about 130 points off from the session highs. Hi.
Hi, Reema. But I think the market's still very much in green mood and green mode. And you're seeing, I mean, the good thing about hitting the peak this time around is that there's no immediate reversal, immediate profit taking, which is what had started setting in when we had the previous high, I mean, that level of around 22,800. So right now, the market seems to be in fine form. And once again, I mean, it's got a lot of different legs. So if we talk about the large cap screen, then, you know, you've got some of the major movers and shakers like L&T and Bharti. They're continuing the good work from yesterday. Heavy hitter like HDFC Bank is still on the positive side. SBI is positive. So it's still a pretty decent looking screen. Not too much of a problem out there. But one needs to watch out for the counterweights on the lower side. ITC has been a bit of a drag since yesterday. Very mixed performance coming in, though the FMCG business and the cigarettes business was on track. But still, I mean, I think because of the weakness that we've seen in the paper business and the agri business, some tweaking of those earnings estimates have happened, and that's been weighing on that one stock. So that's how it is. Let's pull up the contribution chart, actually. You'll see Infosys and TCS also on the downside. So it's a very even split between the big boys on the upside and the pressure points on the downside. Right now, it's even Steven. Reliance, TCS, Infosys, they're on the red side of the screen. But you've got SBI, L&T, HDFC Bank. They're doing the good work for the bulls on the green. And I think as the day progresses, we'll know which camp wins, Reema.
Oh, absolutely. But right now, I think telecom is one of the big movers. Yeah. The way Vodafone Idea is moving, we've had multiple upgrades, But every time we had an upgrade, the target price was about 15 rupees, which means the risk reward never appeared to be that favorable, right? Because you're playing for an upside of 2 to 3 rupees. But today's note is putting the target price at 18 rupees, which means from where the stock started at 13, 14 rupees, the risk reward started turning favorable. And there have been so many upgrades, right? There was Kotak, there was Citi, and now latest UBS. So now all the brokerages who had dropped coverage on, Vodafone Idea have reinitiated it with, a bullish call. But first
I'll just, before we move on, Reema, just quick check on mid-caps as well. The mid-cap index is outperforming the frontline indices today for what it's worth, about 0.4 of an increase coming up on the mid-cap index. And apart from Vodafone Idea, I just want to point out some more stocks that are managing to find traction. Look at a PFC, which is up and about today. Some of the PSU names like GAIL, BEL, they're still finding traction. Some interesting movers beyond the volume chart. So if you look at something like a Johnson Hitachi, there's a 20% circuit on that stock. Some tremendous buying taking place today. So that's one that really stands out. Fertilizer stocks, I want to point out, perhaps it's the onset of the monsoon season, some excitement around that. But your, NFL, RCF, Madras Fertilizer, Tumble, all fertilizer stocks are up almost 8 to 9%. So that's one big move that's playing out in the mid-cap market as well. But anyway, since we're talking about a lot of the movers and shakers, let's also look at Finolex Cables. Now, that stock has been surging after the company reported a good set of numbers for the fourth quarter. Upasna is here with more details. Upasna, fill us in. What has worked so well for Finolex? Almost 17% now.
The company reported good set of numbers in its Q4 FY24. The numbers were above the street estimates. The revenue saw a growth of 14% on a YoY basis and stood around 1,400 crore, while the street was estimating a number around 1,329 crores. The revenue growth was mainly driven by growth in electrical cable segment, which contributes almost 86% of the company's overall revenues. Now, coming to this segment, the revenue saw an uptick of 16% on a YoY basis, while margins dipped 70 basis points and stood at 12.1%. It is also important to know that the share of low margin segments like communication cables also decreased from 14% to 9% on a YoY basis. Coming to company's overall EBITDA margins, they saw a downtick of 30 basis points and stood at 11.6%, while the street was working with a number of 12%, which is slightly below the estimates. The PAT saw an uptick of 6% and stood at 186 crores, while the street was working with a number of just about 145 crores. So all in all, we are seeing a good set of numbers reported by Finolex Cables in its Q4 FY24.
Okay, all right. Thanks very much, Upasna, for that. Let's move on. So that's Finolex on the upside. A stock that's reacting quite dramatically on the downside is actually Orchid Pharma, down almost 8-9%. And that's also a result reaction. So let's ask Ekta. Yeah, 9%, no sign of recovery. So let's ask Ekta what's gone wrong. Ekta, fill us in.
Well, yes, a disappointing set of numbers which is coming for Orchid Pharma. So the revenue was up only around 3.4% on a year-on-year basis. And even on a Q-on-Q basis, the revenue did see a decline. It came in at around 217 crores versus 220 odd crores. What also disappointed were the margins, which came in at only 13.3% versus 18.9% year-on-year. The EBITDA came down by around 27% year-on-year. And on a Q-on-Q basis as well, the margins were 13.3 versus 16%. That really trickled down in terms of the profitability, which came in at around 33 odd crores versus 59 odd crores. And this compares to 33 crores versus 29 crores Q-on-Q. So a disappointment which is coming for Orchid Pharma, which has been pretty much a top-down disappointment, with the margins really standing out as the key negative.
Thank you, Ekta, for that big fall in Orchid Pharma, 9% gone on that. But let's get to a corporate conversation now. Shares of JK Lakshmi Cement are higher in trade after the company reported a good Q4. The key positive was the margin expansion. We generally haven't seen margin expansion in cement companies, but for JK Lakshmi, margins expanded to 16.7% versus about 11% year-on-year. That said, the volumes were a bit of a disappointment. Volumes declined by 4% year-on-year. To talk about the way forward, we have Arun Shukla, President Director of JK Lakshmi Cement, to take a few questions, for us. Thank you for joining in. First, if you can guide on the volume front, what's the guidance on, in terms of volumes for FY25, and can you break it up in H1, H2?
Yeah, so our volume guidance is 10% plus. H1 is going to be around maybe 8% and H2 around 12%. So that is what we are targeting. The reason for a little lower H1 is April, June is not good because of the general election which is happening. And I hope that, after elections, things are going to be better in terms of demand, and hence our growth also will improve. So overall 10% plus, that is what my volume guidance is.
And so what's the pricing trend looking like? What is the current price versus the average of Q4 and your expectation as the year progresses?
Yeah, so prices, once demand improves, prices also will improve. April, June, price-wise, April, May has not been so good because, January, March also prices were stable or going down. April, May also has not been good in terms of prices, and primarily because of the demand. Once demand improves, prices also will go up. From here on, I see that prices will definitely improve, and means at least 1.5 to 2%, 2.5%. That is what I see the price increase. This is what my estimation is based on the fair estimation which I can do as of today.
Sorry, sir, April, May prices, what are they currently compared to Q4 average? You said they're subdued. How much lower?
Yeah, a little subdued, so maybe around a percentage lower than quarter.
And this price increase of 1.5 to 2.5%, how soon will you be able to effect it?
I think that will somewhere, it will happen maybe once demand improves in the month of June and post Diwali. That is what I see prices will.
All right. So that's the view coming in on pricing also. Can you talk about this margin improvement that you've seen? What can you guide now on your EBITDA per ton, because you're also focusing on renewable power?
Yeah, so before that, I think I'll tell you what we have been doing for the last more than 1 year. We have been focusing on all those efficiency parameter or levers within our control. So we have done quite a bit on top line part of it, be it segment mix, geo mix, or product mix. We have also been doing quite a bit in supply chain, improving supply chain efficiency using technology, and cost front, particularly operations front. Our focus was on renewable energy and alternate fuel. All these initiatives are going to, take, further, impetus and focus going forward. Our focus is to further improve upon all these parameters, particularly on cost front. We are going to improve our renewable proportion of energy. last quarter, our renewable energy proportion was close to about 47%, and on an overall basis, last year it was about 37%. So we are trying to take it to 50% in FY25. Similarly, AFR also, we have established capability to use AFR at our different integrated plant. So there also I see some kind of improvement going forward. So these are the two elements which is going to give us benefit in terms of improvement of margins. And supply chain efficiency, of course, I think this is one thing which we have been working on this aspect incessantly, that will continue to work on. There also I think I see improvement going forward. And of course, I think you mentioned about volume. I think our volume was little bit lower on account of some of the outsourced units which we had. Those units were not making much of a sense, so we reduced our volume from those outsourced units. Otherwise, if you see our capacity utilization last quarter was close to 90%, and for the whole year it was 81%. So which is better than the average of the industry.
Mr.
So,
Shukla.
yeah.
Yeah, Mr. Shukla, sorry, so just to go back to the central question, now that you're expecting better volumes, particularly in the second half, you're expecting some stability on pricing, and your sort of your power mix is changing more towards the renewable side. All put together, EBITDA per ton, what is a realistic expectation to have? I believe your last 2 quarters, you've been around 1,000 rupees per ton. Can you just tell us where were you in Q4 and what's the projection now with all these measures?
Yeah, Q4 it was 1,049 our EBITDA, and this is what we have been working on, crossing this 1,000 rupees per ton EBITDA barrier, so which we have crossed in the last 2 quarters. Going forward, also our endeavor is to be around that only, but along with that, I would mention that we'll measure our performance in terms of EBITDA per ton of the industry leaders. We want to be amongst top 3 to top 5 companies in terms of EBITDA per ton. This is what our plan is, and for that we have put up our actions also around this.
Okay, just a follow-up question on just to understand pricing and volume. Volumes, you're saying that overall growth for the current fiscal year should be 10%. The election impact will be over and done in Q1, but then the monsoon period sets in. So Q1 and Q2, will volumes be flat, best case, or will there still be some decline in Q1 and Q2?
So Q2 is going to be better last year Q2, because some of the leftover demand will come in the month of July. August, I think, is going to be almost the same. September definitely is going to be better than last year September. So my estimation is Q2 is going to be better than last year.
Q2 will be better than last year, so we should have some volume growth. Now on pricing, I mean, can you give us some more color on the competitive intensity? And again, by when does the pressure start abating? I mean, is it realistic to expect pricing increases perhaps as we get to that Q2 period when even volumes will improve, you're saying?
I think you need to look at, the capacity addition which is happening. Overall, industry capacity utilization is about, 67 to 68%. If you see, CAGR, 5-year CAGR of capacity addition is 5.4%. and demand is 5.2%. So capacity utilization is lower in cement industry, and that is what has been traditionally even before, because this industry is cyclical in nature. So July, August, September typically low, so you have a lower utilization, and then March, January, March, and October, March, people utilize their excess capacity. So that is what it is. So I think this situation is going to remain. And price movement is going to be dependent on the demand, progression. And typically this happens during Q1 of every year and Q3, Q4 of every year. So this is what I think that pattern will continue even going forward.
Yeah, except this Q4 was different, right? We had pricing compression, so it was a bit of an unusual fourth quarter for cement companies.
It was an aberration, yeah.
Yeah. We were talking about capex. Just a word on capex as well. I mean, there is capacity utilization across the sector. Your numbers have been trending higher as well. Nigel tells us that your capex for FY24 all put together was about 1,000 crores. What's the projection for the current year?
So current year, I think Surat grinding station we are commissioning. So we'll be commissioning around Q3 of this year. So their total capex is about 225 crore. Apart from that, we have railway siding which we are commissioning at Durg. So that is that is getting partially over. Maybe I think by Q2 will be concluding there at that as well. So that is about, 220 crore. So around, 500 crore, that is what the capex. Along with that, some of the announcements which we have done, like, 4.6 million ton capacity addition in central and eastern part of India. So part of that is going to be, spent during, FY25. So exact estimation I do not have as of now, but that we can kind of, consider some part of it is going to be spent this year.
Okay. Just a quick word. What is the current debt? Can you give us the number?
So current debt, I think our net debt EBITDA standalone basis is, 0.22, right?
Okay. And the absolute debt?
Absolute debt, I'll just give you the number. I think I'm not carrying that number, but I think that is not much. Maybe it's 0.22, maybe around 700 crore or odd, right?
Okay. And any chance of a fundraise to fund the capex?
Of course, I think it's going to be in the ratio of 2:1. So we have already announced, 2,500 capex for 4.6 million tons. So it's going to be in the ratio of 2:1 in terms of debt and internal accrual.
And since we're talking capex, money utilization, funding plans, is inorganic growth a route that you're considering at the moment? Anything on the radar? What's the thought process there, sir?
I think right now our focus is on, greenfield and brownfield expansion, and that is what we are focusing on. But we cannot rule out, some opportunity comes in which really gives value to us, and that's also fits into our strategic, perspective. Definitely we'll look at that as well.
Okay. All right. We'll have to leave it on that note. Out of time, but thank you very much for joining in and giving us some idea about the business. That's JK Lakshmi Cement. Q4 has been good because of strong hold and strong control on costs. Though, of course, volumes, pricing, not the best in this quarter for this company and most of the cement companies, actually. That's been the nature of Q4. We'll take a break on that note. We'll come back on the other side and talk commodities. We'll have Manisha Gupta joining in. Welcome back. You're with us on Trading Hour. Let's talk commodities. As promised, Manisha is joining in. And now, Manisha, are you still tracking the silver lining of silver? Any let up in prices, or is it still those record levels? My God, don't tell me it's already touching like 1 lakh or something in the Indian market.
Well, not too far away from that, really, Surabhi. And if you look at, if you add the GST and if you add the taxes to it, people have bought silver at 1 lakh as well. And with expectation that you could be looking at higher prices going forward. The reason I'm talking about silver today is because we are looking at strong gains continuing for the month of May. Silver is outperforming the whole metal as a sector there. And we are still holding around 30.5. The high that we've seen in this week itself has been at 32.5. And for the Indian markets, while an all-time high has been 95,000 rupees, we are holding around 93 to 94 at this point in time. So the strength pretty much has continued. Now, the reasons that the street believes that every healthy dip or a small correction also is good for buying is because you have strong fundamentals backing this. While, of course, the rubber from gold and the strength in base metal prices is supporting silver, but silver also, its own fundamentals have been stronger. This is going to be the 4th straight year that you're looking at a global deficit in markets. If you look at the demand that we've seen come in from solar panels, from EVs, has continued to be on the stronger side. And the street believes that millions of ounces is what you will be seeing being added to demand from industrial side of the category every year in case of silver there. And the supply perhaps will not be able to match on to with that. We also are looking at very strong strength in sense of the ETF buying that has been stronger in the international markets. For the Indian markets as well, we have seen 15,000 crores of holdings now in case of silver ETFs. Also, when you look at the gold and silver ratio, well, that stands at 70 now. It was at around almost 85 and 90 in the month of January. So that suggests that there could be some correction coming in for silver. But that also tells you that the momentum for silver can continue to be stronger. I also want to quickly take you in sense of what we have seen as average prices for last 4 years now. So, of course, 2021 was a strong year. We saw $25 as an average price. The last couple of years was around 21 to 22. But this year, until now, the first 4 months, the silver average price has moved higher to around $27 an ounce. Going forward, the expectation is that you could be looking at higher highs. For this year, we started this year with $23 an ounce. We've done 32.5 already, with the street anticipating that if holds above 32, you could be looking at $34 and $36 an ounce coming in for silver as well.
Thank you very much for that. Time for a short break. On the other side, the management of Nucleus Software Exports will join in to talk about their Q4 numbers and the way forward. Welcome back. Shares of Nucleus Software are under pressure. The stock is down 4%. Yesterday, though, it was higher by close to about 7%. Now, the top line of the company has seen a growth of close to about 2% on a year-on-year basis. And even on a quarter-on-quarter basis, growth has been close to about 3%. Margins are down on a year-on-year basis, but they have improved on a quarter-on-quarter basis. Vishnu Dusad, co-founder and MD of Nucleus Software Exports, is with us on the show now to take a few questions. Thank you very much, sir, for joining in. This is Reema here. First, if you could just talk about this top-line growth of yours. You know, you've been a company which has been seeing very strong growth. Even for FY24, you've seen about a 30% top-line growth. It's just that in Q4, the growth rates appear to have dipped. What happened?
We are in a business which is sporadic in some manner. Our top line depends on the size of the license orders that we are able to pick up, and sometimes the orders get delayed by a quarter or so, and that is where our top line would not reflect the performance.
Okay, so how many orders have gotten delayed? I just want to understand, is this a one quarter? Will growth bounce back in Q2? Or is there a slowness in the market also?
No, I would not say that there is a slowness in the market. There is demand in the market. However, it will depend on, how soon our customers take decisions. Also, our pricing is also something that, it is no longer the low prices at which we were selling. So our customers are taking some time to take the decisions.
So now that you've sort of raised the pricing bar for your own self, will this result in lower growth for you going ahead? Because you were a company which has seen very strong growth over the past many years. So last year was 30%. In FY23, also your growth was 27, 28%. Now going ahead, should we align ourselves to a 10, 15% kind of growth? And what is your own expectation of FY25?
As a policy, we do not give guidance that you may be aware of. Now, and having said that, there is no reason for us to believe that our growth numbers need to be moderated. We would continue to grow at a good pace. This is what I would like to say.
And, sir, what about margins? I mean, what is the visibility that you have? They have increased quarter on quarter, but your peak margins, I believe, are closer to 40%. So what are the cost pressures at play? And given what you're saying about pricing, what can one expect on margins?
Margins would be directly dependent on our top line, because our expenses are kind of built in, and the quarters or the year, wherever the top line is better, we look forward to better margins.
But, is 40% a distant milestone now in the past? Or is the ambition to start going back above, gradually 30, 35, 40? But is it possible to get back to those kind of levels?
Certainly. It is possible.
And what would be the levers, sir? I mean, with what conviction do you say that?
The intellectual property that we continue to create is absolutely world-class, and there are discussions with customers, I would say, all over the world, where they're keenly looking at deploying our intellectual property for their businesses. And, this confidence comes out of those conversations that are going on with our customers.
So you said that your pricing is no longer the cheapest or the least, and you have, taken a pricing correction and increase. What has been the average increase, and is there more to go?
Okay, I would not be able to comment on average increase. It's very, very difficult. It varies from customers' earlier position to current position. We have been able to negotiate and so on. So it's difficult for us to comment on averages.
Sure.
Yeah.
Okay. But are you still in talks, negotiating with your clients for a further price increase, or is that done?
It's with the customers with whom we have got it increased. It is done for the time being, and for the rest of them where we have not been able to negotiate, we will take some time.
So what percentage of your customers have you managed to exact a price increase? Is it 30%? Is it 50%?
No, it's already in the 70-80% range.
70-80%.
And
So with
balance-
70-80% of your customers, there has been a price increase. And with the balance, you're still in talks.
That's right.
Oh.
That's right.
What is your order book now currently, sir? I think last time it was 744 crore.
It is in the similar range. I think 830 crores or in that range.
Okay. And the cash in the books, you are eligible for a buyback. So is that on the cards this year in FY25?
Yeah, board would take that decision. As of now, in yesterday's board meeting, this decision was not taken.
Okay. Your India business is slowed down, both quarter on quarter and on a year-on-year basis. The revenues from India, and that's more than 50% of your overall revenue. Can you pinpoint the reasons for that? And also tell us a little bit more about the deal closures which got deferred. What was the extent of that? How many deals? Were they large deals? Any of them got cancelled, or are they all going to fructify in Q1?
Timeline I would not be able to say, but at least 5 deals would have got postponed, and they were of various sizes, small to medium, I can say.
Okay. All right, sir. We'll leave the conversation here. Thank you very much for joining in and wish you all the very best. We'll get into a break. On the other side, we'll talk market technicals. Jay Thakkar from ICICI Securities joins in next. Welcome back. Today, the day belongs to telecom names, particularly Vodafone Idea, and we've seen a very, very big move in Vodafone Idea. The reason is UBS has upgraded Vodafone Idea to a buy, and they've raised the target price to 18 rupees. So even after the current, up move that we're seeing, there is still some upside to go. Now, this is predicated on 2 triggers playing out. One, a tariff hike. So UBS estimates a 15 to 20% tariff hike, a price increase in the next 1 to 2 years. Secondly, some relief from the government, which could be in the form of AGR dues, the adjusted gross revenue dues that the company has to pay to the government. And according to a lot of analysts, that number could come down by close to about 50%, if not more. So these are the 2 big triggers which are likely to play out for Vodafone Idea. And the reason they're anticipating that is that the government has made it very clear that they want 3 private players. They want this to be a competitive market. The UBS is also making that argument that all the 3 players right now, Airtel, Jio and Vodafone Idea, are trading at similar valuations of 11 times FY26 EV to EBITDA. But Vodafone Idea is the one where there is a maximum upside if these triggers play out. They're most leveraged to any of these announcements, and therefore the risk reward for Vodafone Idea is the most favorable. So which is why they've upgraded Vodafone Idea. They, as in UBS, has upgraded Vodafone Idea to a buy with a target price of 18 rupees. But for Airtel and Indus, it's still a neutral call. So that's the big call coming in from Vodafone by UBS on Vodafone Idea, which has got the street excited.
Absolutely, and it's really showing up on the stock. Already has moved to a level of about 15 rupees now. That's Vodafone Idea, 10% today. Well, let's talk about a couple of interesting trades that you can look at and the index levels. Now that we did get that milestone of 23,000 on the Nifty, we have Jay Thakkar joining us, and he's with us in the studios today. Jay, so great to have you in. Tell us, 23,000. The question is, is there more to this move and this rally?
Thank you, Surbhi. Good morning to you and Rima. Well, see, what's happened is every time we have seen, Nifty, since Jan of this year, is that Nifty makes a new high and we see a sell-off coming from there on, right? And again, it clocks a new high by say a couple of 100 points to 300 points, and again we see a sell-off. So last time what happened is it just made a lifetime high by say 4-5 points. And thereafter, we saw 1,000 points cut.
Sell off, yeah.
And then, Nifty sort of formed a range of, say, 22,800 to 21,800. So that was 1,000 points range. And that range has got broken on the upside. So, if you just go technically, then, you can see the levels of, say, 23,800. I mean, that could be the target on the upside. But then not forgetting the previous trend also, or the previous pattern also, that whenever it makes a new high by, say, a couple of points, couple of 100 points, it makes a sell-off again. So those levels comes to around say 23,200. So at least in the short term, you can see 23,200 coming on Nifty. So that's another say 200, 250 points from here on till 22,800 levels are held. It's just the only thing is that Bank Nifty is just not has not made a lifetime high. Rest most of the sectoral indices, or maybe you see broader markets, they are the lifetime highs. So if you see more momentum coming in Bank Nifty, that can help Nifty to surpass those 23,200 levels as well.
But you are seeing the likes of HDFC Bank, for instance, move today. So HDFC Bank is up close to about 1%. Jay, what's changed this week is that large caps are outperforming mid caps.
Absolutely,
so week to date, the Nifty is up 2%, while the mid cap index is up 1.4%. What would be your stock specific calls? And do you expect large caps, blue chips to lead the way?
Absolutely, Rima. What we have seen is that mid cap, small cap, or maybe broader indices, probably few sectors like auto, metals, they were performing quite well. They were forming new lifetime highs. But then banking was struggling, mainly because of HDFC, Kotak, and the likes. But then I think now the index heavyweights are ready for an up move from here on. We are seeing fresh breakouts coming in out there. Hence, I've got 3 buy recommendations, and all of them are from Nifty 50. The first one is on Reliance. I think Reliance seems to have completed its consolidation, or correction. And from here on, I think that till 2,900 levels out there are held. In the short term, we can see the levels of say 3,060, 3,100 coming very soon in the near term. Second buy recommendation is on Ultralex Cement. Now, this has underperformed quite a lot. And from here on, I think it can see the levels of 11,000. It's trading around the levels of 10,300 on the downside. I believe that 9,700 would be a very crucial support for it. And the third buy recommendation is from the banking pack. I think one of the outperformers in the banking pack is Axis Bank. Post its results, we saw a huge up move of almost 6-7% in a day. Now on the downside, I think it has got a support nearly around 1130. So with that as a stop loss, one can buy this targeting 1220 on the upside.
Okay, so big large cap moves, and why not? I mean, if yesterday was anything to go by, over 4,600 crores of FII money coming in, that's big buying, and it's been missing all through this year. Those kind of numbers are missing in the market. Let's see if it becomes a pattern or not. Jay, before we let you go, I'll actually give you a couple of minutes to perhaps look up some consumer stocks and tell us if you like anything over there. We are just going through some earnings right now, and in fact, we have Manglam with us. So both Bikaji and Honasa, both of these stocks have reacted pretty well to their numbers. Let's go across and figure out how the fine print looks. I think on Bikaji as well, the stock's still up about 4%. Manglam is here with us. Manglam, tell us more.
Well, a lot of bhujia was consumed. That's the lowdown on Bikaji, because the numbers were doing well.
With pretty-looking people with good skin, can we say?
I guess so. So the thing is that for Bikaji this time around, the fact that they had entered into this capex plan, etc., got them a lot of PLI benefits too. So the other operating income of the company was aided by around 94 crores. Even if you adjust for that, the volume growth of the company was close to around 14% in the fourth quarter. Revenues grew just about 13%, and that led to margins staying stable around that 13% mark as well. And we saw net profit growth of 22%. Now, if you look at the segments of the company, nearly 3/4 of the company's revenues coming from ethnic snacks, which is bhujia and the likes. Out there, the revenues grew around 11%. And on a lower basis, we saw good growth come by for some of these unorganized to organized shifts, like packaged sweets, where the revenue grew about 13%. Papad, there was a growth of around 23%. And Western snacks as well, where the company is looking to diversify into, saw a revenue growth of around 15%. So Bikaji looking good, looked a lot better on a reported basis. But if you take off the benefits, still looks good. For Honasa as well, I remember when the management joined us during the IPO, they said that their target would be to grow at least 2 times the industry. And this time around, they've gone a step better. They've grown 3 times their competition. And as a result of which, their underlying volume growth in the fourth quarter has been 27%. The revenue growth has been 21.5%. And on companies, which grow so fast and which are just turning around, operating leverage plays a big difference. So which is why the EBITDA has come in over 30 crores versus a loss of, a similar amount last time. And the net profit also at around 30 crores versus a loss of 16 crores. Importantly, they are seeding businesses beyond Mamaearth as well. So last month, you got the news that, Dermaco had crossed 500 crore as annual revenue run rate. Now they're targeting 1,000 crore in the next 3 to 5 years from this brand, about 500 crores for Aqualogica and Dr. Sheth's as well. And B Blunt, which they acquired from Godrej Consumer, will now, look at around 250 crores over the next 3 to 5 years. So they're growing and gaining market share in their key products as well, like shampoos as well as face wash.
So, Mangalam, sorry to spring this on you last minute, but just I'm taking a shot in terms of valuations for Honasa. Frankly, one would have expected maybe a bigger pop today, given the strength of the numbers. So I don't know. The stock is still not back at its peak levels. But just rough check on valuations here.
Well, rough check on the valuations would be upwards of 70, 75 times on Honasa, but that would not be very fair, largely because the pace at which the company is growing. So maybe the brokerages will have to tweak their estimates. Their estimates were of a certain pace of growth, and the company has grown a little faster than that. Plus, remember, despite the kind of margin improvement that we've seen, we haven't yet seen the ad spends leverage play out. For FY24, the ad spends of the company were down by just about 100 basis points and still about 33-34%. So as other brands scale up, and once that comes down, there is a bigger upside to margins. And with the kind of growth path that the company is on, maybe once brokerages tweak estimates, it'll be fairer to look at valuations then, rather than looking at static numbers right now and saying that it trades at around 70, 75 times.
Okay, fair enough. I will take that caveat on board because I was thinking, oh God, I mean, the moment you said 70, 75 times, I thought that was the answer why the stock is not moving up, because, we have the rest of the market that started moving. But take your point on board as well. So let's see how those estimates look once the brokerages tweak the numbers.
Jay, a quick word on the consumer names? Anything you like?
Sure, Rima. In fact, as far as Honasa or, Bikaji is concerned, I believe that Bikaji is in a very clear uptrend, and I think that can inch towards the levels of, say, 625. In fact, relatively, I find Bikaji much more, better as compared to Honasa.
Thank you. Thank you very much for joining in. Get into a break. On the other side, we'll discuss market fundamentals. Chirag Mehta from Quantum AMC joins in next. Stay tuned.
Welcome back here with us on Trading Hour, and the market's still sort of, flirting around with a bit of the green. There's been some red, but there is buying at lower levels. That's the short point. Chirag Mehta from Quantum AMC is with us to talk about, how they're positioned on the market as a whole. Chirag, hi. I was going through your fact sheet, the April note, and what really stood out was that it seems that y'all are very happy to take on board all the strong macro cues, all the good numbers on GST, etc. But I think the moot question here, the principal question here is valuations and how much is still left on the table. So let's start there. Your view on this big rally.
Yeah, so we are very positive on markets rather than markets, it's economy is where we find a lot of comfort in terms of momentum that is there in the economy. All the macro indicators suggest still robustness in the economy. So we are pretty positive on the economy per se. But much of the good readings that we have or the positivities in the economy are priced in most of the sectors. So overall, from a valuation standpoint, there is little comfort in the market. The upside potential that we track of the portfolio has been declining. Stocks have been doing well, but the upside potential on account of that has been declining. But there are pockets of opportunities that we see in the market where we are positioned very well. For example, the pockets of BFSI, especially the private banks, is a good position that we have across our funds. We still think that that sector has not participated as much, and there is a lot of room from a valuation standpoint, from a growth standpoint, to benefit by positioning that sector. Also, we like auto and auto components as a space. So we think there is a lot of demand momentum in that that we would see going forward. And that would lead to the leg up in terms of that sector participating. We have seen some up move in autos, but we think there is still further room when it comes to auto and auto components as a whole. And third thing that we like from a sector perspective, which we may take some time, but it's great time from a valuation standpoint, is the IT sector. The discretionary spend is still not picking up the like way we'll want. But overall, we think that as you normalize your numbers going forward for the IT sector, for example, in the US, banking, there has been hardly any spend from the banking sector over the last 2 years, which we think will pick up going forward. And as that happens, there will be a lot of normalization that will happen in the numbers, which will allow us to benefit from positions in the IT sector as well. So these are the three top themes that we like from a valuation standpoint as well, and also from a growth perspective. And hence we are positioned in these sectors optimally in our portfolios.
So you said banks, autos and IT are your top 3 preferred sectors, right?
That's right.
Okay. What about metals? Have you trimmed positions in metal names? Because there is one half of the street which believes that there is a super cycle underway. Base metal prices have been rising, notwithstanding the recent correction that we've seen. But generally, commodity prices have shot through the roof. So where do you stand on metals?
So on metals, there is a economic momentum coming from the capex plays that are happening not only in India but elsewhere as well. So there is a demand, plus the rebuilding that is happening because of the greening of the economies. That is also leading to increased demand for metals. Also, the earlier we used to see a lot of supply dump coming from China, which is not happening because of the capacities going down or being shut because of the environmental regulations. So there is not much supply acceleration that is happening, even though prices are holding up well or going up. So from a supply demand standpoint, there is a momentum from a demand perspective, and prices are holding up well or moving higher a bit. We are not so positive on the prices continue to go higher, but demand momentum may continue from here on. So we do have some exposure to metals, but much of the demand positivity is already in the price to an extent. But certain names in the steel sector, for example, we do like and hold in our portfolio.
Okay, so Chirag, those are some of the sectoral sort of thoughts. You know, just from a market cap perspective, how are you looking at the mid cap, small cap market? I mean, the entire market is up and about, and now the Nifty is also hitting fresh highs. But incrementally, what would your advice be? And I'm talking about a medium to high risk investor here, not the low risk variety. But for such an investor, would you be comfortable with the increased allocation to mid and small, or is large cap the way to go?
So certainly the valuations in large cap are still better on a relative basis as compared to mid and small cap. Mid and small cap look a little stretched. But in a small cap, when you're approaching that space, you have to be more stock selective as opposed to having an aggregate approach in the small cap space. And in that, we do see certain pockets of opportunities where we are positioned in the small cap. We do hold some cash in the small cap fund. That's because we don't find enough opportunities to deploy that cash. But to the extent we have good names within the small cap space where we are positioned onto. So in that, industrials as a sector. So industrial as a sector overall looks very expensive, but there are pockets that we see there is still momentum left. We do like IT even in that, and BFSI in that space as well. So there are pockets of opportunities within small cap space, but on aggregate, it looks pretty expensive from a valuation standpoint. So from a market cap landscape, large caps look the best in terms of valuation positioning. Within the small cap, you have to be more selective. There is a lot of growth that's coming to companies in the small cap sector. There are certain unique ideas or unique themes that you could play in the small cap sector, which is not available in the large caps. And hence, you need to allocate more to large caps, but also have some positioning in the small cap space as well.
Okay, got it, Chirag. Chirag, before we let you go, I mean, the other hat you wear is obviously an expert on the precious metals market, and you've been watching those markets for a very long time as well. So before we let you go today, just over there, I mean, the headlines have been absolutely scintillating. We were just discussing the rise in silver prices with Manisha as well. What's the advice to investors? I mean, if someone is feeling a bit of a FOMO, they haven't had a proper allocation on gold and silver, from an investment standpoint, then does it still make sense, or is it just too late?
No, I think this still makes sense. But what we are seeing currently is some unwinding of the geopolitical premium that is getting priced in. So we're seeing some correction in gold, and probably there could be further some correction, but the downside seem limited from here. What's really driving is the macro forces with terms of one is geopolitics and another is unsustainable debt levels, etc., and the subsequent turn in rate cycle, which is the driving force for gold and other commodities as well. So we think that if there is any dips that you get in gold markets, probably they should be bought into. We are in up for pretty decent 2 to 3 years out there as rate cuts happen. Debt still remains a worry for many of the economies, and as the economy slow down, there could be further support and a U-turn from many of these central banks out there. So we are positive from a 2 to 3 year outlook perspective on gold markets. Downsides will be limited and should be bought into.
Okay, all right, Chirag, we'll leave it on that note. Thank you very much for joining in and giving us your views on the market. We'll take a break right now, come back on the other side with a lot more. Quick programming note for our viewers. Join us live on 31st of May from 5:30 p.m. onwards for CNBC-TV18's Future Female Forward, the Leadership Circle, a transformative platform where leaders from diverse fields would venture beyond the traditional discourse and share stories of grit and determination and the road less traveled. This Leadership Circle is not just about business strategies and professional accolades, it's also about delving into the depths of the personal journeys of these trailblazers.
Welcome back. As promised, we'll get you our special segment, Fin Street, where Abhishek today puts the spotlight on microfinance lenders. Take a look.
High inflation isn't a friend for the rural economy, and this is leading to pain in the rural sector, which has become visible over the past 2 quarters in the asset quality of lenders who are actually focused in the microfinance segment. And it's also showing up in the loan growth rate, which has declined in H2 FY24 versus the growth that they had in H2 FY23. Gross NPA of the lenders increased by more than 32% in H2 FY24 versus H1 FY24. This compares to a decline of 32.5% in H2 FY23 when compared to H1 FY23. This is surprising, as H2 is usually a better half for the microfinance lenders. For 70% of the lenders, the gross NPA has increased anywhere between 22% to 124% in H2 FY24. ESAF SFB, their gross NPA increased by 124% in second half of FY24. Credit Access Grameen, a top-notch microfinance player, saw its gross NPA rise by more than 83% in second half of FY24. The rise in H2 FY24 NPAs compares to a decline in gross NPA for most of the lenders in H2 FY23. Like Suryodaya Small Finance Bank and ESAF Small Finance Bank, they saw their gross NPA decline by more than 60% in H2 FY23 versus the number of H1 FY23. Credit Access Grameen too saw a sharp dip in its gross NPA by 34% in second half of FY23. Rise in NPAs has impacted the credit cost of the lenders, and provisions have increased sharply for majority of them. Provisions increased by 8.5% in H2 FY24 when compared to the number of H1 FY24. Largely in Q4 FY24, majority of the provisions have come in. Ujjivan Small Finance Bank provisions have increased by more than 94% in H2 FY24. ESAF Small Finance Bank, their provisions have increased more than 59% in second half of FY24. In H2 FY23, provisions for lenders has actually declined by more than 38% when compared to the number of H1 FY23. Satin Credit Care, Spandana Spurti had seen their provisions decline by more than 60% in second half of FY23. AUM growth rate has slowed down as well in H2 FY24 versus the growth rate that they had in H2 FY23. So H2 FY24 AUM growth of the lenders has been about 16.3% when compared to H1 number, and they had a growth rate of 22.8% in H2 FY23 versus the H1 of FY23. So growth rate has been impacted the most for Spandana Spurti, ESAF SFB and Equitas Small Finance Bank. The key takeaways are that high inflation and elevated interest rate may continue to impact the repayment in the microfinance loans. Some lenders are also showing high disbursements but lower loan growth, suggesting repayment issues. Hence, loan growth rate has started to slow down for majority of the lenders in the microfinance segment. Given this, pain in the asset quality can continue in the near future for small ticket loans.
Very comprehensive, Abhishek. Thank you for that. And with that, it's a wrap on Trading Hour from the entire team. Thank you for watching.